Yeah. Now, rationality and logic is coming back to the market. Chennai Petro, you look at Chennai Petro, you look at MRPL, the selling I think was very, very intense, and now the stocks are stabilizing. Reliance also, bear in mind, yes, the profitability will get impacted, but nobody was expecting the profitability what they are likely to report for the quarter gone by would was permanent, and that is largely because of the fact that that unusual spike in GRMs is not going to sustain. $9-10 GRM is what you will maximum get in Reliance, because that's the nature of the business in terms of the demand supply scenario. Ajay Srivastava joins us, CEO with Dimension Corporate Finance Services. Let's take our conversation forward to understand from him what he's telling his clients to do. Good morning, Ajay.
Good morning.
It's looking okay. I won't say good or great, but it's looking okay. Markets have suddenly stopped falling, and mid and small cap stocks are finally showing signs of life.
Absolutely. I would say it's a great relief rally for the Indian investor, which has seen, I think, Reading for last how many months now altogether. And also gives a chance to them to ponder over that why did this sit on their entire portfolio while this whole mayhem was going around. I think the implication of last couple of months and more recent, Nikunj, is the fact that the whole philosophy of investing now needs to change. It needs to become a little more short term, because not only in India, world over, the political class no more fears the economic, let me say, economic disadvantages they bring to the table with their policies. Look at US. They dumped a president with the best economy, lowest rate, lowest unemployment rate for a man who pumped 2 trillion when inflation was going high. And look at where the world is today. The same situation applies here, whether you look at windfall taxes, whether you look at export taxes in India. These economic policies don't give you comfort as a long-term investor. And the reason it is that this is a bumper profit which creates a corpus to do more investment. India needs to, for instance, do more explore oil, right? Now, if you tax the bumper profit, you take it away from the companies. So I think from an investor standpoint, I think you need to be realistic about your long-term aspiration on equity market. And more critically, one simple fact, now book your profits, because when the economic policy changes, and it's true total of the world, not only India today, you will never know it, and all your profits will disappear. So I think the cardinal lesson now we're telling investors is, listen, you need to start let people book your profits, take your cash home. Nothing is long-term in this world. The old paradigm of investing is dead.
Now it's time to book profits, because we've seen a rally. It could be a bear market rally. If it is a bear market rally, raise the cash.
No, I think some stocks definitely you need to get out of, because I still believe that when the recession is coming and growth is going to slow down, there is no doubt about it. RBI is saying so. How much more, we don't know the answer. Economic policies are a little longer term. Nothing will happen next morning, but in 3 to 6, 9 months time, you'll see the implication of what has happened. So I think definitely this is the stage, and market has shown us also mid caps and small caps certainly are not the place to hide. You want to be adventurous with your portfolio for an alpha return? Sure, take a 10-20% bet on that. But the game in town is still going to be the large caps, because that is going to survive. And if you look at it, last 12 months, the only index positive is the large cap index, really speaking. That's the one which has gone into positive at this point of time. So I would say it's not about just booking profit. It's about booking profit in the right places, more important. And, eschewing booking losses perhaps could be the worst strategy in this market.
Outside of the index, or rather inside of the index, Ajay, what do you do now with the highest weighted stock, Reliance Industries, after the announcements that came by from the government? That and ONGC, actually.
See, PSUs have always said, you know me very well for so many decades, literally, that PSUs, I said never buy it unless you're buying for a dividend yield. Yeah, okay, buy it, forget it, counter dividend yield. They're not a capital gain thing. That's not what the government is here for. So ONGC, I would put it in that bucket saying, and the dividend yield has not been so good as well. So I think you have to be careful with people like ONGC. So forget ONGC. I think people like Reliance, we have seen it in the past. Of course, this was an unfortunate government policy issue, but that stock kind of remains steady for a long time, then picks it up, perks up, then remains steady for a long time. But you definitely don't want to bet against it in a longer term framework. So if you are an investor in this country, and this is one company which straddles so many sectors at this point of time. It has retail, it has technology, it has straddles petroleum refining, chemicals, so it's hard to get a conglomerate. And if at all, whenever it happens, the companies separate, I think you could get some little kick off in terms of your returns. We don't know when it's going to happen, but if you have to bet on Indian economy, like we used to say earlier, where do you start? Used to be HDFC twins, no more. They have been the most accursed investors, cursed today in the market at this point of time. And then you start with Reliance and others. So I think as an Indian investor, you have no choice but to start from there. So it's not about whether or not. I think it's a must for a portfolio given the amount of industry it spans.
Indeed. Ajay, the other thing I also want to talk about, TCS is going to be reporting its numbers later this week. Is the pain already in the price after the commentary that we've heard, not from the Accentures of the world, but from N. Chandra himself?
You know, again, we have to look at TCS, forget this quarter, next quarter, from a little longer term perspective. And then I keep saying that it's a very IT India is a very good investment in the cash market. To play in a futures market with a short term horizon, you could be playing with fire with these stocks because that's not the way to do this. But if you're a cash buyer of TCS, if you're a cash buyer of Infosys, you are safe and sound at the end of the day. Business is robust, it's not going to go away. Still, the rest of the world has to catch up on IT. It's only America dominated by and large. These companies pay back returns to shareholders. We have said so many times, governance is not such an issue at all in these companies. So, if you put all those things together, and rupee dollar, given what we've done to ourselves, the rupee dollar is going to keep aiding them no matter what happens. And in this market now, with unicorns being so-called unicorns being, we'll talk about it, being under a little bit of cosh at this point of time, their ability to retain tech talent also will improve quite substantially, in my view, in the next 12 months. Therefore, all in all, I think I do not know whether the pain is there, because the pain in equity is going to be there for some time for all investors. But I think longer term, you'll be very safe and sound with healthy returns in this sector. Among all the Indian industry sectors, this perhaps offer the best place to be at any point of time. And, market can go up and down, but you got to be there but in the cash market, keep it as a cash holding.
Good morning, this is Nantara. So when you talk about one of the best markets out there, tell us where you're putting your money. In the past, you, for example, talked about multiplexes, saying that's a great bet. You've talked about the QSR space as well.
No, we have, in fact, of late, we have been pulling out our money from the cement. Is zero at this point of time. So we have not got any money in cement. We are stuck, let me be honest about it, in the metal space where the call has gone wrong at this point of time. So I must share with investors that we also make mistakes. We are not the brightest sparks in the world. But where we are putting our money right now, we're trying to find money to put in agriculture related companies. We're trying to find money to put in a cotton yarn back into the cotton yarn companies, because I think they've suffered a lot. And if that commodity changes path, you will see growth coming into this thing. So I think it's a very limited buying at this point of time. It's nothing at all. If you ask me, it's nothing at all. And we are still sticking to our strategy of leaving our money in investment trust, which is the Power Investment Trust. I think it's still there. We have put some money in the real estate as well. But across the board buying, no. If you ask me, equity portfolio, we are asking customers to shrink it a little bit and keep some more firepower going at this point of time. Consumer durable, we have become zero at this point of time. We were there, but we become zero at this point of time. So I think it's been selective, move out then move in, Nantara. I'm sorry, but that's the way we feel about the market.
Okay, cement is zero. You're looking at agri commodities. I don't know if you've turned now bearish on QSR and multiplexes, a space you were bullish on, I think, back in March and April in the entire reopening trade. You're looking at opportunities when it comes to cotton. So I would imagine milk companies as well as fashion companies. What about the banking pack? We've been waiting for that pack to start performing. You had talked about, a shatter in confidence when it came to the HDFC twins. I'll never forget you saying that.
Okay, banking industry is a hope industry at this point of time. Everybody's invested in it at this point of time. So everybody has to kind of take it up at this point of time. We do not know whether the reality of the banking industry, the way it stands today, at least the PSU banks aren't going to be in trouble very soon, because the Mudra loans are going to start coming to the table. And the fact that they have increased the MSME exposure, now that's not sounds good to me, because your composition of your bank risk is changing. So leave aside PSU bank for argument's sake. In the private bank space, look at what has happened. HDFC, death blow. Axis Bank struggling to, and I don't know what they will do after they absorb Citibank and what's going to happen at the end of the day, because that's not the smartest way to do things in the world, but well, they've done it now. Kotak steady as a go. So I think these three, and ICICI is the second one, where bank is doing okay. Now all the subsidiaries are now kind of like on the sidelines, not growing so well. So, what is banking index? Banking index is these four stocks, and banking industry is these four companies. So it's the gamble is that these eventually, thanks to the lending, etc., these banks will come up. On the flip side, the argument is that the supply of domestic stock will start hitting because people will start getting out of this heavily weighted stocks which everybody owns. Everybody owns these banks at this point of time. So I think it's going to be and of course, what's going to happen to government debt. We don't know how much of the pain will come in the June quarter results. It's not very clear whether RBI will allow them to carry it forward, move more to a HTM market, etc. So, net, I think it's a trade of hope. And if you're betting on Indian economy and stock, you have to start here, because at the end of the day, how much more can it fall is an argument rather than how will it increase on a positive spin. I'm on the view that kind of saying that how much more can it fall? And if the FI selling in the banks has stopped, I think you'll get some strength in the banking stocks. But that's all about it. I think if you're really buying on some gangbuster fundamental, I think you could be disappointed. If you're buying from demand supply, things may change. Perhaps you'll get a little better yield than the market. But well, that's what it is. You just have to now look at demand supply. If selling stops, I think banking would do a little better than what it has done. If selling doesn't stop, I think you'll have to wait a lot longer with the stocks.
On Vedanta, I mean, it's got this real mystery around itself. High dividend yield, good capital allocation, but a reversal in metal prices.
Well, we hold the stock. So for disclosure purposes, we are quite biased, and we have just now blocked our mind to the fact that yes, we will have to ride through this storm, and if it goes down much more, we will add on to the stock, because longer term, it's a monopoly, it's an under leveraged monopoly, and if the zinc thing comes through, it'll do better at this point of time, and therefore, I would say at this point of time, no matter what the government policy is, you can fight economic forces for some time, but you can't suppress it for all time, because it'll come back to bite you in the back at the end of the day. So did demonetization. Today, you have left with an economy which is 80% surviving on free food grains and government employment. So our view is that these monopoly industries, commodity industries linked to US dollar prices will do well. They have a short-term setback, policy setbacks, but eventually with rupee where it is, their production value is going up for nothing but the rupee dollar as well. So I think hang in there, add on corrections, and ride it through, because there is good money flowing through the system, and they will also stop the capex at the end of the day. So that money would come to shareholders and not go into the capex. So all in all, ride the storm, because this has been a tough year when it should have been the bumper year.
Ride the storm, hold on to Vedanta is the word that's coming in from Ajay Srivastava, who's also been candid enough to share with all of our viewers that the call on metals has gone bad. It's always a pleasure talking to you and getting your candid take on the markets. Thanks for being live with us this Monday morning.